Amazon entered 51.3 billion euros in sales throughout Europe in 2021, which represents a record sales figure, after growing 17% compared to the previous year's figure. With this, Amazon's European subsidiary declared losses of 1,160 million euros in 2021. Still, with its substantial growth to date, Amazon doesn't pay taxes. Why do you pay taxes and Amazon doesn't? But first, please like and subscribe to the channel and then sit back and relax. Is it true that Amazon does not pay taxes? The firm argues for modest profits because it is a very competitive business. A tweet by a popular US congresswoman brought to center stage a report on the web giant Amazon's tax burden over the past 2 years. While the company doesn't pay federal income taxes in the United States, it reported tax payments of $1.2 billion the previous year and $957 million in 2017. Since the numbers aren't broken down geographically, it's hard to know which government received that amount of money. Democratic Congresswoman Alexandria Ocasio-Cortez tweeted about some press reports talking about an investigation by the Institute for Taxation and Economic Policy that showed that Amazon did not pay income taxes in the United States for 2 years. Ocasio asked on Twitter, why should corporations that don't put anything in the coffers be in a position to take billions of dollars from the people? A Fortune magazine article indicated that Amazon paid no federal income taxes in 2017 and 2018, even though its domestic profits doubled to more than $11 billion in that period. Ocasio said on Twitter that this meant $0 for schools, fire, infrastructure, research, and healthcare. What's known? Amazon said that it was not required to pay federal taxes on its U.S. income for 2017 and 2018. It was required to receive refunds from the federal government. Its pre-tax income in the United States, the company detailed in its official documents, rose 100% to $11.2 billion. The company tax burden was lower due to deductions for compensations based on depreciating assets and stocks. As a result of the 2017 tax cuts, which reduced U.S. corporate tax rates to 21% from 31% previously, Amazon also estimated that it would receive a profit of $789 million. But that does not mean that you have not paid any tax. For 2018, it reported that it owed $322 million in taxes to U.S. state governments and another $563 million in the rest of the world. Under a separate accounting category, Amazon reported cash taxes paid, or the number of funds paid in taxes, of $1.2 billion the previous year and $957 million in 2017. But these numbers don't break down geographically, so it is not possible to know which government received the cash. Paying some taxes. ITEP's core claims are backed up by Amazon's reporting. However, more context may be necessary to understand the situation. The company pays some taxes but has drawn controversy in the United States and across the Atlantic for finding ways to reduce its overall tax burden, common among many companies. According to Matt Gardner, an ITEP member who wrote the Amazon report, Amazon's tax burden for state taxes is approximately 2.9%. That is unquestionably greater than zero. Additionally, according to Sabuhi Sardarli, a finance professor at Kansas State University who has studied corporate tax avoidance, Amazon has laid aside money for potential future tax obligations that could be greater. The internet giant claimed that it had invested more than $160 billion in the United States since 2011, building a complex distribution network as well as cloud computing infrastructure. Amazon pays all of the taxes we are required to pay in the United States and in all countries where we operate, including paying $2.6 billion in corporate taxes and $3.4 billion in tax expenses over the past 3 years. Amazon generated 51.3 billion euro in 2021 but did not even pay even €1 in taxes. According to reports, Amazon managed to enter 51.3 billion euros in sales in Europe last year, and despite this, the company did not pay a single euro cent in taxes. As if that wasn't enough, he even received €1 billion in tax credits. For this to be possible, it is indicated that Amazon reported 1,160 million euros of losses in 2021, which allowed the company not to pay income taxes and receive said 1 billion euros in tax credits. Specifically, Amazon defended itself by indicating that the payment of taxes is not associated with income but with profits. And that is why, when presenting losses when expanding their business in Europe, they are exempt from paying taxes. The Luxembourg-based business posted sales of 51.3 billion euro the previous year, up 17% from 43.8 billion euro in 2020. The unit, called Amazon EU Sarl, includes revenue generated from its trading activities electronically in the UK, Germany, France, Italy, Spain, Poland, Sweden, and the Netherlands. Across Europe, citizens pay a corporate tax that amounts to hundreds of millions of euros, while income, benefits, and taxes are communicated to the local authorities of each country. The company said it posted losses after opening more than 50 new centers across the continent last year. Amazon claimed to have been investing heavily in creating jobs and infrastructure across Europe, more than 100 billion euro since 2010. Corporate tax is based on profit, not revenue, and last year Amazon EU Sarl made a loss, as it opened more than 50 new centers across Europe and created more than 65,000 well-paid jobs, bringing a permanent workforce in Europe to over 200,000 workers. The Amazon method: how the e-commerce giant avoids taxes. An investigation by experts from the University of London reveals some of the e-commerce giant's maneuvers to contribute less fiscally. The company responded that Amazon complies with all US and international tax laws as well as financial accounting standards in all countries in which it operates. It is often said that the only ones who pay the taxes that correspond to them are the employees, the self-employed, and small businessmen, while large fortunes, whether private or business, are capable of creating financial architectures to pay much less than their fair share of taxes. Something like that happens with Amazon. The European Commission itself is claiming 250 million in illegal tax benefit in Luxembourg. Although the General Court of the EU has considered this week that the community executive has not sufficiently demonstrated that this has been the case. In a study prepared by professors and researchers from the University of London, they call the Amazon method how to take advantage of the international system to avoid paying taxes. Some of the e-commerce giants' maneuvers to contribute less fiscally are revealed. The real tax planning strategy, which is the accumulations of losses generated mainly by non-EU subsidiaries to create tax credits instead of producing profits they maintain. Multinationals employ some of the sharpest legal and accounting minds to exploit the system of rules, regulations, and taxes created by states, particularly the loopholes that arise between different jurisdictions to avoid paying taxes. The less multinational companies pay in taxes, the more someone else has to pay, usually sectors of society that cannot use those professional services to pay less. And Amazon responded to the publications that the report provides an inaccurate description of the basic provisions of US and international tax regulations. Amazon complies with all US and international tax laws and financial accounting standards in all countries in which we operate. Corporate taxes are based on profits, not income, and our international profits have remained low due to our large global investments. The tax laws are designed to encourage the kind of investments Amazon is making to move the global economy forward. The report analyzes how Amazon has organized its domestic and international businesses to minimize taxes around the world by using information contained in Amazon's annual US Form 10K filings, an annual report required by the US Securities and Exchange Commission with the financial performance of a company and the accounts of European and UK subsidiary companies. You have to understand that the whole is bigger than its parts and apply unitary taxes to multinationals to prevent the transfer of profits and similar practices of tax evasion. There's a need to anchor the concept of significant digital presence in tax regulations to avoid the non-taxations of digital business models. Finally, there is a need for a European tax on surplus profits to spread the costs of the crisis fairly. Equity mapping. The study also uses the equity mapping technique to study Amazon's international activities over the past decade with the records of its affiliated companies and thus study Amazon's tax planning strategies. The equity mapping techniques was developed from a corp-link study funded by the European Research Council. Existing studies have concluded that Amazon pays little or no tax in the US. However, due to opaque reporting, exact figures are disputed and less scrutinized. Amazon's activities outside the US. Thus, we identified certain gaps in the available data as presented by Amazon, which raises significant questions about the role that Luxembourg and Amazon's non-EU subsidiaries play in the company's tax planning. According to experts, losses generated outside the EU appear to have been converted by Amazon into tax credits in the US, ensuring that Amazon pays little or no tax. And the analysis leads to the conclusion that Amazon operates a specific tax credit arbitration scheme coordinated through subsidiaries located in Luxembourg. Over the past decade, Amazon has generated more tax-free profits than the amount of taxes it has paid. Much of this has taken the form of retained losses, an accounting term that describes net operating losses that are used to reduce future tax liabilities. Amazon claims to follow the law. After the EU court ruling, Amazon professed that they are committed to Europe and follow the law in all the jurisdictions in which they operate. According to Amazon, which has 60 logistics centers, 100 corporate offices and development centers, and more than 135,000 employees working in a variety of well-paying roles, they have invested $78 million since 2010. Today, there are more than 100,000 European-based sales partners who use their services to reach new customers and grow their businesses. And small businesses account for more than half of all products offered in their stores. The company stated that its position from the beginning is that they comply with all applicable laws and that Amazon has not received special treatment. According to the study published by this group, Amazon's total net operating loss carryover reached $13.4 billion in 2020. This figure was higher than the total taxes payable by the group for the entire history of the group up to date, which is around $11.71 million. Much of those losses originated from Amazon's non-European subsidiaries. Unfortunately, Amazon's reporting on its international affairs raises questions about its fiscal affairs. Why? The data reveals that loss has been a common and recurring feature distributed among many members of the corporate group. For example, one of Amazon's Indian subsidiaries generated more than $3.46 billion in cumulative operating losses over the past decade. Its operating expenses average 220% more than the level of operating income reported by the company. Despite accumulating large losses internationally, Amazon also accumulated $17.2 billion non-repatriated dividends in its international segment. How Amazon posted such huge losses while racking up unreturned profits remain a mystery. Under the US rules for controlled foreign affiliates, these foreign accumulated earnings are supposed to be taxed in the US. Dividends, however, are never formally repatriated but are instead reinvested in international activities in perpetuity so they remain tax-free. The accumulation of tax deferrals has been used to drastically limit the level of taxation. Luxembourg is at the center of Amazon's system of globally coordinated losses that simultaneously also generate non-repatriated benefits. The set of Luxembourgish entities represents the inexplicable 75% of all Amazon international sales. The European Commission investigated Amazon in 2015. From this investigation, it is plausible to infer that unrepatriated dividends are the result of the illicit transfer of profits. However, the Commission's investigation narrowly focused on only 2 Luxembourgish subsidiaries. And more importantly, it did not focus on the actual tax planning strategy, which is the accumulations of losses generated mainly by non-EU subsidiaries to create tax credits instead of producing profits. Thus, we understand that the EU investigation should focus on the simultaneous increase in international losses and non-repatriated benefits coordinated through Luxembourg. Amazon appears to purposely create opacity by reporting and presenting data in confusing ways to hide the potential of its aggressive tax planning strategy, and it presents another mystery. Although it is increasingly in importance and now accounts for more than 10% of Amazon's global sales, it is not clear how much tax Amazon Web Services pays or even if it pays any tax at all. Enough of this scam, there is a need for tax justice. And proactive action by EU leaders is needed to tackle tax evasion by companies like Amazon and a proper reinvestigation by the European Commission. Transparency and mandatory country-by-country public reporting are necessary for all large corporations. Also, not allow corporations to make countries compete against each other thanks to the applications of an effective global minimum corporate tax rate of 25%. It's also suspected that other large US companies may be following a similar strategy thanks to opacity in accounting, tax, and corporate governance. As a result, it is impossible to identify the precise amount of taxes paid or avoided not only by Amazon but also by other multinationals. During a costly pandemic, delivering tax justice and fairness around the world is more vital than ever. Many experts stated that they cannot afford tax abuses by multinationals. Scammers like Amazon need to pay back the taxpayers they have been fleecing for years. The insufficient information and the obscurity of the reports are outrageous. The public can't see how much tax these corporate giants ultimately pay. The truth is that Amazon is not the only large international company that uses methods like these. This research provides us with valuable insights into the tax planning strategies of global corporations in general, especially big tech. Taken at face value, Amazon's international business has declined steadily over the past decade, from a peak of 48% of the group's net sales in 2009 to 27% in 2020. However, Amazon's reports on its international affairs are perplexing and raise questions about its fiscal affairs. Amazon's primary financial focus is on revenue growth and cash flow. Amazon relies on its cash liquidity rather than its profitability to pay for maintenance and expansion. The group has sustainably generated operating cash flows at approximately 10% of its revenue. Cash flow management is much more fundamental to Amazon's tax planning strategy than is commonly assumed. Second, Amazon has made extensive use of US accelerated depreciation allowances to write off the value of its fixed assets, like all of the hardware and computing infrastructure that falls into its fastest growing segment, Amazon Web Services, thereby reducing profitable taxable income. The accumulation of tax deferrals, the largest of which has typically been losses generated in foreign markets, have been used to drastically limit the level of income taxes that are supposed to be paid out of your cash flow. What are the procedures for Amazon sellers to collect sales tax? In 2018, Amazon started requesting sales tax from Washington retailers. From that point on, Amazon's sales tax collection quickly spread throughout the country. This is a result of the market facilitators' laws. E-commerce platforms must gather and pay sales tax on behalf of vendors in these states. Online brands need to be well-versed in how Amazon's sales tax collection works. It may seem complex at first glance, but it's quite effective once you get the hang of it. That's why we have put together a little guide to help you successfully navigate collecting Amazon sales tax. Let's dive in. What is sales tax? A sales tax is a one-time fee that customers pay when they purchase goods and services. The seller then collects the percentage of the sale and remits it to the government. Please note that state and local policies determine sales tax rates. For example, Amazon sellers must add 2.9% in Colorado but 6.25% in Illinois. In the end, it is the customer who pays the taxes and the online sellers must collect them. But for Amazon, this was not always the case. In the past, online consumers could buy a product and walk away without paying sales tax. Things are quite different today, and no one is affected more than retail hubs like Amazon. The law of the market facilitator. Amazon has implemented sales taxes for its products, but it did not always apply value-added tax on third-party sales. This led to the enforcement of marketplace facilitator laws by many US states since 2017. These laws were put in place because Amazon's physical presence, with warehouses in most US states, made it responsible for the sales tax nexus. A sales tax nexus refers to having a significant presence in the state of being obligated to pay sales tax. Marketplace facilitator laws encourage platforms like Amazon, which have an active sales tax nexus, to collect and pay seller sales tax on behalf of merchants and post notices and report fees to customers and the government. Sellers must declare that sales tax is due on the purchase of a product using order forms, invoices, and receipts for customers and the Department of Revenue. However, in general, it is the sales platform that handles the collections of sales tax. Third-party brands, on the other hand, are still responsible for collecting tax from their sales. This is how Amazon's sales tax collection works for sellers. The market will handle tax collection and payment, so sellers don't have to worry about sales tax nexus or pay extra fees for tax collection services. Amazon will even take care of filing out and submitting the 1099K forms. However, sellers will still need sales tax permits and must authorize Amazon to collect sales tax in Seller Central. Sellers need to understand how Amazon's sales tax works, in case Amazon doesn't collect tax in a specific state. For instance, Amazon doesn't collect tax in Missouri as of July 2021, and 4 states have no sales tax. Amazon can collect the right sales tax for each US territory and specific products like clothing and groceries, and can detect rate changes and whether a state is destination-based or source-based. However, the marketplace usually charges 2.9% of each sale to collect tax, and international sellers must collect tax themselves in foreign countries. If you enjoyed this video, don't forget to hit like, the subscription button, and the notification bell to get notified when new videos are uploaded from this channel. Please share your thoughts about why you pay taxes and Amazon doesn't in the comment section below. Thank you.